In 1951, Warren Buffett bought 350 shares of a stock for $10,282, and less than a year later, he sold those shares for $15,259, a 48% profit. Buffett was just 21 years old at the time. He was still studying at Columbia Business School, and while the trade might seem trivial, it's the series of events in Buffett's life that year that molded his investment strategy that would later make him billions of dollars. This is one of the rare moments where we get to see into the mind of a young Warren Buffett, because he was writing about it in great detail as it happened, and there's so much we can learn from it about picking stocks today. So let me tell you the story, a fascinating journey from New York to Washington DC and to Omaha, in which a young Warren Buffett discovered a stock that would become etched across his entire life. At the beginning of 1951, Warren Buffett was studying at Columbia Business School in New York. He chose the school not because of its prestige, but because he wanted to learn directly from Benjamin Graham. Those familiar with their finance history would know that Graham is known as the father of value investing. He wrote a textbook called Security Analysis with fellow Columbia professor David Dodd in 1934. They made the cover a bit nicer for the 6th edition. And then in 1949, he wrote The Intelligent Investor, which is around here somewhere, but I couldn't find it. 19-year-old Warren Buffett read the book in 1950 and thought it was the best book about investing ever written. To this day, he largely credits his success to it. But even better, he learned how to analyze stocks directly from Graham at business school. Having bought his first stock at age 11, Buffett was already investing his own money. He had about $20,000 to his name, the equivalent of $250,000 today. But 1951 was a frustrating time to be a value investor. He wrote, "Full employment, boom time profits, and record dividend payments do not set the stage for depressed security prices. The US was 2 years out of a recession. The unemployment rate was just 4% and would fall to 3% by the middle of the year. Real GDP was growing at 10% a year, and investors were pouring money into stocks, optimistic about the future. Most industries have been riding this wave of prosperity," he wrote, "with few ripples to disturb the tide." Value investors need ripples. They need people to doubt the future of great companies, so they're willing to sell you their shares for much less than they're worth. 1951 was the complete opposite. Not only did investors have full confidence in great businesses, they were throwing money at companies that couldn't possibly meet their rosy projections for growth. But Buffett was about to stumble upon the opportunity of a lifetime, an investment that would set him on a journey down the east coast of America to a meeting that laid the foundation of his investing success. And it all started with a book. I need to take a quick pause in the video to give a huge thanks to the sponsor of today's video, Incogni. I'm sure you've noticed just how bad spam phone calls and text messages have gotten recently. My phone basically rings every other hour, and then I miss genuine calls because I keep my phone on Do Not Disturb. And this is because of a wonderful thing called data brokers. They've sold your phone number to businesses that think cold calling still works. But they're also selling things like your address and financial data, so that people search sites can build a public record of your private information. But there is a way out. Data brokers are required by law to remove your information if you submit requests. A process that's near impossible to do by yourself, but super easy when using Incogni. Just create an account, give them permission to act on your behalf, and they'll handle the whole process, completely hands-off. So if you're uncomfortable with your data being sold over and over again, head to incogni.com/Hamish or use code Hamish when signing up, and you'll get a huge discount on an annual plan. Studying investing under Benjamin Graham made him Buffett's hero. He wanted to learn everything he could about him, so he picked up a copy of Albert Marquis' book, Who's Who in America. In it, it stated that Graham was sitting as chairman of a business called Government Employees Insurance Company, or GEICO for short. Graham's investment firm had acquired a 50% ownership in the company in 1948, but the sale accidentally violated an SEC regulation. So in 1949, the Graham-Newman partnership listed Geico on the stock market to divest some of their investment. Buffett, of course, deeply trusted Graham's judgment, and so Geico was now front and center on his stock-picking radar. Investing in companies with good people leading them is one of Buffett's key pillars. Geico hit three very important elements right away. The first being Graham was chairman of the board, and then there was Leo Goodwin, who had guided Geico's growth since inception and was still the president of the company. Geico was founded by Leo and his wife Lillian in 1936. While certainly not foolproof, founders tend to have values aligned with shareholders. But even better is if the directors of the company are big shareholders themselves. Buffett wrote, "The 10 members of the board of directors owned approximately 1/3 of the outstanding stock." The only problem was Buffett knew absolutely nothing about the insurance business, but he wasn't going to let that stop him. He headed to the university library and found what might be the nerdiest book I've ever heard of, Best's Fire and Casualty Insurance Manual. As he read, he began to realize that the auto industry had a number of favorable characteristics. Auto insurance is regarded as a necessity by the majority of purchasers, he wrote, and the hazard of product obsolescence and equipment obsolescence is absent. It was a business that didn't require constant spending on the maintenance of physical assets, and there was unlikely to be any innovation that made insurance unnecessary. But most interesting to Buffett was that the industry wasn't caught up in the market euphoria. The auto industry business has not shared in the boom. The recent earnings reports of casualty companies, particularly those with the bulk of writings in auto lines, have diverted bull market enthusiasm for their stocks. The Best's insurance manual indicated that Geico's company headquarters was in Washington, D.C., a 3-hour train ride. Buffett could read all he could find on insurance, but he knew the best way to learn would be to go to the source. So off he went. On an icy morning in January 1951, Buffett rode a train down to Washington, D.C. When he got to the Geico headquarters, he was disappointed to find that it was locked. He pounded on the door for a while, but the building seemed deserted. Then, to his surprise, a custodian came to the door. "Is there anyone working in this building today?" Warren asked. "Just one person, on the 6th floor," the man replied, before letting him inside. That person was Lorimer Davidson, the assistant to the founder and president of Geico. Buffett told Davidson that he was a student of Benjamin Graham, and what followed was later described by Buffett as the greatest half-day course in how the insurance industry functions. Buffett learned what made it an attractive industry to invest in. Lack of inventory, collection, labor, and raw material problems, he wrote in his article. Bodily injury and property damage were among the least profitable lines, but collision was a profitable line in 1950. Buffett then directed his questions towards Geico specifically. He'd read that Geico's earnings in 1950 were $3.92 per share, as contrast to $4.71 in 1949. But he learned that the decline in profitability was a normal part of the industry, because of a lag of rates behind costs. Contracts must be renewed yearly at rates based upon experience. So in an inflationary environment like that of 1950, costs rose before the rates for premiums could be increased. But this mechanic would become beneficial if deflationary forces should be set in action. Davidson explained to Buffett that Geico's business strategy was different to their competitors, and it gave them a huge cost advantage. Geico had no agents or branch offices, and claims were handled by approximately 500 representatives. This, coupled with their standardized insurance products, meant they could offer premium discounts running as high as 30% off manual rates. This wasn't being replicated by their competitors because the traditional agent model was so deeply ingrained. This is exactly what Buffett was looking for in an investment. A company that had a unique competitive advantage that resulted in higher returns on capital and was unlikely to be replicated by industry peers, something Buffett would later call an economic moat. In Geico's case, their moat gave them a significant profit margin advantage. Ratio of underwriting profits to premiums earned in 1949 was 27.5% compared to 6.7% for the 135 stock casualty and surety companies summarized by Betts. The difference was even more noticeable in bad years for the industry. In 1950, aggregate profit margins dropped to 3%, and Geico's dropped to 18%. The results when viewed over decades were astounding. Between 1936 and 1950, the value of premiums written rose from $104,000 to $8 million, a 39% per year compounded growth rate, and the number of policyholders was growing at a compounded rate of almost 30% a year. Geico was what Buffett called a legitimate growth company, taking a jab at Wall Street, who uses the term much more liberally. The term growth company has been applied to companies whose sales increases represented little more than inflation of prices and general easing of business competition. Buffett was beyond impressed, and so he made an investment shortly after the trip. In the middle of 1951, Buffett finished his education at Columbia and traveled back to Omaha to work at his father's small stock brokerage firm, Buffett, Falk & Co. As an investment salesman, he was pitching the stock to potential investors, including one critical missing piece. The investor of today does not profit from yesterday's growth. Fortunately, in Geico's case, the majority portion of growth lies ahead. The company's full unleashed potential had been somewhat handicapped until 1950. Prior to 1950, they were only licensed in 15 of 50 jurisdictions across America. So replicating their strategy in the remaining jurisdictions would be a huge tailwind. And while inflation was hurting all insurance businesses, with insurance rates moving higher, the 25% spread in rates becomes wider in terms of dollars and cents. Every time costs rose, Geico's cheaper option became even more attractive. Buffett continued to buy Geico stock for his personal portfolio. Tax returns that he held onto for more than 40 years showed 4 purchases totaling 350 shares and costing a little over $10,000. Buffett would go on to making a somewhat larger investment in Geico decades later, but I'll get to that in a moment. He now had more than half his net worth riding on the stock. Buffett was extremely confident in the stock because of the final critical element of his strategy: the price. On December 6, 1951, Buffett wrote an article for a leading financial publication titled "The Security I Like Best." It's what I've been quoting throughout this video. And on the price of Geico, he wrote, "Present price of about 8 times earnings of 1950, and this was in a poor year for the industry." So the price was cheap even when compared to an abnormally low profit figure. It appears that no price is being paid for the tremendous growth potential of the company. The stock was priced like a company with little growth in front of it, so any growth would practically make it a home run investment. And it was, pretty much immediately. Less than a year later, in 1952, Buffett sold his 350 shares for $15,259, about a 50% return. He sold because he found what he believed to be a better investment opportunity: Western Insurance Securities, another insurance company, but this one was selling for just 1 times last year's earnings. These lesser quality but dirt cheap stocks were the kind of thing Buffett was mostly buying in his early years as an investor. Investing frequently in the types of companies like Geico didn't come until much later, largely due to the influence of the late Charlie Munger. I don't know exactly how much he made on that 1 times earnings stock, but what we do know is that had he not sold his 350 shares of Geico, it would have been worth $1.3 million within 2 decades. A lesson in holding onto the stock of great companies. But Buffett redeemed this blunder a few decades later. In 1976, now running Berkshire Hathaway, he bought 33.3% of Geico, and then up to 50% of the company over the following 15 years. Finally, in 1995, he bought the other 50% for $2.3 billion, bringing Geico into the Berkshire family as a wholly owned subsidiary. Here's 2 more similar videos if you need something to watch next, and consider hitting subscribe.